Let's look at another way we can look at valuation, right? In this case, we're looking at the relationship between earnings and dividends. We're utilizing a portion then of what we refer to as multiplier models. So we're going to be utilizing the PE ratio of the company. So let's think about what information we need, right? We need to know what the company's current earnings per share is. In the historical, earnings per share times 0. We then need to know something about growth of earnings, the required return of the company, and their estimated dividend payout ratio. We can calculate required return by using the security market line formula. So we have a risk-free asset of 3, a return of 3, beta's 1.5, market returns 11. So this gives us a required return of 15%, and of course we can plug that into this model. We also need to know something about the growth rate of earnings and the required returns of the company. So we need to work on those things, right? So how can we do earnings per share? So if we have the company's historical earnings per share, 2015 to 2019, and their dividends, we can calculate the dividend payout ratio. So again, just 75 cents divided by $1.50. In 2015, dividend payout was 50%. We can find the average. So we have the average dividend payout ratio, 53.1, and the average earnings per share growth is 7.46. So this 3 data points are all calculated with this particular data. How this then fits into our model, we need to predict then over the next, we're looking at 4 years out from 2020, we're looking to 2024. We want to estimate earnings per share per year. That's just what? The current earnings per share times the growth that we calculate over here. Estimated earnings per share, we have the average. Again, this is rounding it off, is 54%. Estimated dividends, we know what the dividend is because it's a percentage of earnings. And then we need to find the present value of those dividends. This then allows us to calculate the price. The earnings per share, we estimate the earnings per share out here in year 2024 to be $3.08. We need to understand or predict what we think the PE ratio will be 5 years from now. It's a pretty hard number for us to think about, but we can find what's referred to as a forward PE ratio. That number is published. So we can find that number. Maybe we go someplace like Yahoo Finance, and they publish this particular number. So the future price in 2024, we expect to be $48.52. To find the value of the stock, then, we have to find the present value of the price. But this is also kind of working off of our supernormal growth stock model. We also have to find here's the present value of the dividends. So if you sum the dividends that we get in years 1 through 5, and you add that to the present value of the price, this stock today should be worth $28.84. So this utilizes the supernormal growth rate model that assumes that growth rates are not always constant, that there are some changes, but it also then utilizes the multiplier model to help us understand how they are combined to calculate the value of the stock. So again, this is just another model, right? Using different information, evaluating how this stuff all fits together for us to make financial decisions, right? So how do you make the stock price go up? We need earnings growth, right? We need to have maybe our estimated dividend payout ratio, maybe we need to reduce that a little bit. Let's reinvest more of our money rather than pay it out to our shareholders. So we can manipulate this information to see how the variables affect the price. Again, look forward to talking to you soon. Bye-bye.